हेलो फ्रेंड्स, वेलकम टू लर्निंग सेशंस। बीएफएम की तैयारी से रिलेटेड दिस इज आवर नेक्स्ट वीडियो. So if you're preparing for the CIB exam 2026, then definitely this video is for you. And this is the fifth session for the bank financial management, and we are going to start with the case study. And this case study is related to the capital requirement based upon the module B. I've already told you previously that module B is the most important module in the BFM. And today we are going to cover the concepts and further case study, first of all, related to the module B. I've told you the concepts related to the Basel 3. Related, I told you that what is standardized method or standardized approach for the credit risk, also related to the internal rating based approach, whether it is FIRB or AIRB, advanced internal rating based approach. I told you about the components of the capital, and this case study which is mentioned over here, it's related to the components of the capital. So we are going to discuss about this case study. Please do confirm the audio video quality at the earliest so that we can proceed. Please do confirm the audio video quality so that we can proceed. And if you have been watching our videos for a while, if you do like our videos, kindly do share this video among your friends and colleagues and give this video a thumbs up so that we can get more videos for you. Right? Audio video quality is working all fine, and from today video onwards, the classes will be available, the live sessions will be available only through our Android app. Right? You can download the Android app using the link iibf.info/app. The link must be visible on the screen, so you should be visiting this link and must be downloading the application. The next class will be on the application only. You'll be finding the links over there and through which you can access it. Now let's focus on the today's session. It's related to the case study on the capital requirement. Case study on the capital requirement. So it says that we are provided with the different data. We are provided with the authorized capital, paid up capital, statutory reserves, PNCPS, perpetual non-cumulative preference shares, premium in PNCPS, debt capital instruments for tier 2 capital with a residual maturity of 3 years and 6 months, general provision and loss reserves, and the revaluation reserves. I'm going to number all these terms first of all. 1, 2, 3, 4, 5, 6, 7, 8. So in total, we are having 8 components which are mentioned over here. So first of all, you need to classify all these components one by one after one. You need to tell me that number 1 would be authorized capital is related to what component? What component of the capital? There are 3 types of components, as I told you. Either it could be CET1, common equity tier 1 component, or AT1 component, or it could be the tier 2 component. So if I talk about the component 1, that is numbering 1, to which capital it belongs to? Kindly do answer at the earliest. Do message over here so as to participate. The more you participate, the more you'll be able to learn the concepts. So do participate at the earliest. I request you all to participate at the earliest. So authorized capital is not related to any type of the capital. It is not related to the any type of capital. So it won't be related to any of it. Paid up capital at the end of the previous financial year. This is the component related to the CET1, AT1 or tier 2 paid up capital. It is related to the CET1 component, common equity tier 1 component. Statutory reserves. Statutory reserves are also related to the CET1. After that, PNCPS, perpetual non-cumulative preference shares, that's related to additional tier 1 capital. Premium in PNCPS, again related to additional tier 1 capital. Debt capital instruments for tier 2 capital with a residual maturity of 3 years and 6 months. it would be the tier 2 capital. As mentioned, it's related to the tier 2 capital. General provisions and loss reserves, again tier 2 capital. Revaluation reserves, that is related to the CET1. Previously those were accounted for tier 2 capital, but now that's related to CET1, that is under the tier 1 capital. Is that clear? The first point here, it says that we need to calculate the CET1, common equity tier 1 capital. Common equity tier 1 capital. So let's write down the terms over here. So it's related to 2 plus 3 plus 8. Is that clear? So there are three components, 2 plus 3 plus 8. So second is having the amount of 3000. All are in crores. So it is 3000 plus 2250 plus 2500. Right? So there are three components under the CET1: paid up equity capital, statutory reserves, and the revaluation reserves. But the revaluation reserves are accountable at 55% discount. At 55% discount means only 45% of the value of 2500 is to be considered. So it will be 3000 plus 2250 plus 2500 minus 55%. So if we calculate, kindly please do carry simple calculator with you. 2500 minus 55%, that is 1125. So this term here would be equal to 1125, and we'll be adding them all. So it is 6375. So your CET1, common equity tier 1 capital, is 6375 crores. Here they have simply asked to calculate the CET1, not the ratio. We can also be calculating the ratio if it is asked in the exam. So what will be the CET1 ratio? If we are given to calculate the CET1 ratio or percentage, how it can be calculated? It is a CET1 capital. Formula is CET1 capital, and further divided by what? Divided by the total risk-weighted assets, which in the question are given to be 90,000 crores. So we'll be taking the sum total of the risk-weighted assets. So that would be equal to 6375 divided by 90,000 multiplied by 100. So that is 6375 divided by 90,000 into 100. That is 7.08%. So the CET1 percentage is 7.08%. Is it clear so far? Kindly confirm at the earliest. If the concepts are clear to you, and if I have understood the topic related how we can calculate the capital, because such kind of questions are definitely to be there in the exam. Definitely you will be asked about such type of questions in a way or another. Right? Another one this says this one only. So we have already calculated this, right? We have already calculated this thing. So we are not going to solve it again. Let me just bring the solution down here. Right? So the answer should be mentioned somewhat over here. Is that clear? So we have already calculated it. CET1 capital ratio, how it is to be calculated. I just told you the formula related to it and everything. We just calculated it. The next one, it says that we need to calculate the AT1. That is an additional tier 1 capital. Now the components in the AT1 are related to what? Either it is PNCPS. In case of CET1 we are having the 10 components. But in case of AT1 we are having only 3 components. PNCPS, perpetual non-cumulative preference shares, plus share premium of the PNCPS, if there is share premium of the PNCPS, plus if there are any perpetual debt instruments. those would be related to the three components of the AT1. Here in the question, PDIs or perpetual debt instruments are not given, so only two components are there, right? PNCPS and share premium for the PNCPS. One it is 2000 and the other one it is 200. Okay, so for PNCPS it is 2000 and for share premium of AT1 it is 200. So the total would be equal to 2200. So AT1, that is additional tier 1, is 2200. But if you mark this answer 2200, it may be wrong. It may be wrong. Why I'm saying it may be wrong? Because I told you that AT1, in case of AT1, PNCPS and share premium of PNCPS, it is to be restricted up to maximum of 1.5% of total risk-weighted assets. So whatsoever the total risk-weighted assets, it is to be restricted. The PNCPS and share premium is to be restricted maximum at what point? Maximum of 1.5%. Is that clear? So here we are having the total risk-weighted assets to be 90,000 crores. If I'm not wrong, let me just double check it. Yes, it is 90,000 crores. Okay, so 90,000 crores multiplied by 1.5%, that would be equal to what? 1350 equals to 1350. So this is leading to what? That the maximum amount can be of 1350, but the amount that we are having as capital available is 2200. So the accountable amount is only 1350. Let me write over here so that whenever you revise, you don't get confused. So accountable amount is what? It is 1350. And what about the rest of the amount? The rest of the amount will be accounted toward the tier 2 capital. So it is 2200 minus 1350. That is 850. That is 850. Now this 850 would be accountable toward what? It will be accountable toward the tier 2 capital. Toward the tier 2 capital, right? Now the AT1 ratio would be equivalent to what? 1350 divided by 90,000, and that is 1.5%. So the answer is very much clear about this ratio. Clear so far? Please confirm at the earliest. Right. Now let's move toward the next question. It is about calculate the tier 2 capital. Now let's have a look at the tier 2 capital. It's quite interesting, right? Because there are some restriction toward calculation of the tier 2 capital, and we should be looking into all the possibilities which can be there. That's all about solving the question is. Okay, so we are having for the tier 2 capital, we are having number 6 and 7 only. Number 6 and 7 is related to the tier 2 capital. So it's one thing, it's related to the general provision and loss reserves, that is 1600. And further, we are having the debt capital instruments tier 2 capital with residual maturity of 3.5 years. Okay, so let's go to the question again. So it says under the number 7, we are having general provisions and loss reserves. General provisions and loss reserves. Now this amount is 1600. Right? This amount is mentioned to be 1600. Okay. And the another one, it's related to the debt capital instruments, DCI, debt capital instrument, and we were having the residual maturity of 3.5 years. That was given to be 800. It was mentioned to be 800. That was the scenario. Now, for the general provision and loss reserves, the maximum limit is 1.25% of the total risk-weighted assets. For the total risk-weighted assets, 1.25% is accountable toward the general provision and loss reserves. So total assets are given to be 90,000 multiplied by 1.25%. So it is 1125. 1125. So 1125. Only this is accountable toward the tier 2 capital, right? And not the other one. Plus the DCI is given to have the residual maturity of 3.5 years. Now I told you very much clearly about the debt capital instruments. What it was all about. That in case of the debt capital instruments, if there is given to be residual maturity, you have to follow a table, right? If you don't memorize the table or remember the table, let me just tell you. And on the other side, you have to write the discount which will be charged. So when it's related to residual maturity less than 1, 2, 3, 4, and 5, and discount would be like 100%, and then step it by 20, 80%, 60%, 40%, and 20%. Is that clear? Is this clear to you? Please confirm. Right. So we are having the residual maturity over here. And in the question, we are provided that we are having the residual maturity of 3.5 years, means lesser than 4 years, but greater than 3 years. So it will be related to here. Less than 4 years. Okay. Less than 4 years. So the discount of 40% would be applicable. So we are to deduct the amount of 40% here. So 800 minus 40%, that is 480. So 480 value is to be considered. Is it clear? Please confirm. Is this point clear to you so far? Right. So it is 480. Okay. After that, another amount is to be added up. And that amount is related to what? That amount is related to the difference of the 81 or surplus of the 81, which was 850. That is also to be accounted for tier 2 capital. So 850 will also be related to the tier 2 capital. Okay. So it is additional 81, I can say. It was related to additional 81. Right? Something like this. Now, the total would be equal to 1125 plus 1125 plus 480 plus 850. That is 2455. 2455. That is your capital. But there are few some checks which you need to keep in mind. First of all, the first check is related to that the tier 2 capital cannot be or should not be more than 50% of the total capital. Should not be more than 50% of the total capital. That is a one point that we need to check, and that's not the case over here. Total capital is way more. Like we have already calculated like 1350 for the 81, and for CET1 it was 6375. So definitely that is not the case. And the second scenario, it says that the tier 2 capital at no point should not be more than 100% of the tier 1 capital. So that is also not the case. Total tier 1 capital is equal to 1350 plus 6375. That is 7725. And that's not the case, right? So tier 2 capital is 2455, and that's all fine with us. But we need to check. We need to check all the criterias. Okay. So that's the case. Tier 2 capital we have calculated. Now calculate the total capital required. Now the total capital is required to what? It is tier 1 capital plus tier 2 capital. Tier 1 capital plus tier 2 capital. And in tier 1 we are having the CET1 plus 81 plus tier 2. So these are the components. CET1 we calculated to be 6375. Kindly please do check the figures again. 1350 over here. And tier 2 was what? We just calculated tier 2. It is 2455. It is 2455. So it comes out to be 6375 plus 1350 plus 2455. That is 10180. So this is a total capital. Total capital. And if we are to calculate the CAR, that would be equal to total capital. Total capital divided by the total risk-weighted assets. Total risk-weighted assets. And multiplied by 100. So we are given total capital to be 10180. Total risk-weighted assets are given in the question itself, 90,000 multiplied by 100%. So that is 10180 divided by 90,000 and percentage, that is 11.31%. 11.31%, and that would be the correct answer here. Is that clear so far? Kindly please confirm if you're clear with these points. Please do confirm at the earliest if you have understood this particular case study, because this is way much important, very much important, so as to understand. Right? Kindly please mention yes in the chat box if you have understood the concept so that we can move ahead. Now, let's move to the capital charge for the operational risk. Capital charge for the operational risk. And two methods out of three are very much important for the numerical point of view. One, it is basic indicator approach, and the other one, it is a standardized approach. Previously, we calculated the capital charge for the credit risk, and now we are talking about the capital charge for the operational risk. Okay, and when we will be solving the case study about it, it will be much more clear. But let me just give an idea that in case of the basic indicator approach, or we simply say it to be BIA approach, in this scenario, we are to get the average gross income for the last 3 years. So if we are having the gross income of 3 years divided by 3, so as to calculate the average, and we have to multiply it with the alpha. Now alpha is what? Alpha is having a fixed value, and the fixed value is equal to what? 15%. Right? So this is the formula related to it. And the second one, it's related to the standardized approach, or SA, or TSA, we simply say the standardized approach, TSA. Right? In this scenario, we are actually given about the 8 different business lines. 8 different business lines, and each and every business line is having the beta associated with it. In case of BIA, we are having the alpha, but in case of the TSA, we are having the beta, right? And for 8 business lines, we are having the different betas, like beta 1, beta 2, beta 3, and beta 8, right? And if we do calculate the average of all the betas, it will be coming equal to the 15% itself. Okay, but for this case, we'll be multiplying the gross incomes with the beta 1 factor, and then we'll be adding them up all. So it is much more, we can say, particular or more sensitive than the BIA approach, right? For the calculation of the AMA, that is not to be covered in the syllabus as per the IIBF. The questions won't be asked related to it. Okay, you just be knowing that the AMA is there, that the advanced measurement approach is there. That is it. Okay, now but we'll be solving the question and case study based upon it, so do not worry, we'll be solving the case study based upon it very shortly. Further, it's related to capital charge for the market risk. Capital charge for the market risk. So if we are to calculate the capital charge for the market risk, it is by the standardized approach maturity method, or the duration method, or the internal model method. From the exam point of view, duration method will be covering in the next unit, not related to this unit, and that is important only, right? That is important. Further, now let's move to the second pillar. Second pillar, that is the supervisory review process. So the main thing is that under the pillar 1, we are dealing with the minimum capital requirement. The word that you should be focusing upon is minimum. It's not about the adequate. It's not about the adequate. Why it's not adequate? Because in pillar 1, we are just concerned about 3 major risks. We are concerned about the credit risk, market risk, and operational risk, and none other risk. So it may be the case that there is some residual risk left. There is some residual risk there in the banking sector or in the bank profile, which is yet to be covered, for which the capital is to be covered, right? So that is the part which is played by the SRP. In short, we say the pillar 2 to be the SRP, that is supervisory review process. Okay. So main objective is that the banks are to ensure that they're having the adequate capital, and it is having two components. The one component is ICAAP. Make sure you should be memorizing it right now. So it is having two components. One, it is ICAAP, which we say to be internal capital. Why I'm writing? It's written down there, but I'm writing over here so that you can understand it, right? Internal capital adequacy and assessment process. Now, the name suggests each and everything about it, that what is going to be there. So it is a process which is followed by the regulated entity, which is followed by the bank, so as to check that whether we are having the adequate capital as per the risk we are taking, as per the bank profile we are maintaining, as per the product range we are offering, as per the customers who are associated with us or not. So it's a process to check the adequacy of the capital. It's the process to check the assessment, to assess the particular things that we are going to assess as per this model, that we are having the particular capital, yes or no, right? That's it. And the second component for the SRP, supervisory review process, is SREP. Now SREP, it is supervisory review and evaluation process. It is supervisory review and evaluation process, right? And as the name suggests, see, the first part, ICAAP, is followed by the bank. The second leg is followed by the regulator, that is Reserve Bank of India. Okay. So in case of SREP, that is supervisory review and evaluation process, what the banks are going to do, the banks should be reviewing and evaluating this ICAAP model and the strategy, so as to evaluate that the capital that we are going to maintain is adequate. First thing that the supervisors are to do, so as to evaluate the model, which is going to be followed by the bank under the ICAAP. That's the first thing. Second thing, supervisors must be expecting that the banks are operating above the minimum capital ratios required. Minimum regulatory capital ratios required. The bank supervisory should be expecting the same. And third thing, the supervisors should be intervening at the early age, so as to prevent that the capital never goes beyond the minimum levels, goes below the minimum levels, right? So these three things are to be followed by the regulator or the supervisor, we can say. That's why it is said to be supervisory review and evaluation process. The first one, it is ICAAP, internal capital adequacy and assessment process. The second one, it is related to SREP, supervisory review and evaluation process. Clear to you? Okay. Now, ICAAP, as the name suggests, internal capital adequacy and assessment process, I already told you. And ICAAP is related to the bank's procedure, bank's measure, and SREP is related to the regulator. This is related to supervisor, or we can say simply regulator. Okay, is that clear so far? There are some principles, and there are 4 key principles related to SRP, that is pillar 2. For pillar 2, we are having 4 principles. One, it is related to that the banks must be having the process so that they can assess the overall capital requirement for the adequacy purposes, and supervisors should be reviewing and evaluating those internal processes. Supervisors must be expecting the banks to operate above the regulatory capitals. And fourth, the supervisors must be intervening at the early stage, so that the capital never falls below the stipulated minimum levels, right? So those are the 4 key principles, very important, right? It may be asked you in the exam like a statement type question, that which one of the following is not a principle under the pillar 2, right? So such type of questions are asked, right? So you should be clear about one part, that pillar 2 is all about making the process and checking the process. right? So process is to be made by the banks and is to be checked and evaluated by the supervisor. That is it all about. That is it all about, right? Further, the pillar number 3, it's related to the market discipline. The pillar 3 is for the market discipline. Now, in case of market discipline, as I suggest you, this pillar supports both pillar 1 and pillar 2. It is complement to both of these pillars, and it's about the transparency. It's all about the transparency in the system which is to be maintained by the banks. So for that particular purpose, disclosures are to be made, and these disclosures should be at least on half yearly basis, and there are some exception related to it which are to be done on quarterly basis. Otherwise, all the disclosures must be there at least on half yearly basis. Only some exceptions are there. Like one exception is related to capital adequacy, which is to be done on quarterly basis, credit risk general disclosure, which is to be done on quarterly basis, and credit risk disclosure related to the portfolios under the standardized approach, that is also to be done on the quarterly basis. So one, it is related to the CAR value, CAR or CRAR value. Second one, it's related to credit risk general disclosure, and the third one, it's related to the credit risk disclosure of the portfolio, right? So these are to be done on the quarterly basis, else all are to be done on the half yearly basis. Kindly please make a note related to it. You should be knowing this. Is that clear to you? Kindly confirm. So we read all basic about the pillar 1, pillar 2, pillar 3. We have already read all about it. If these points are clear to you, make sure to like this video at the earliest, and do share this video among your friends and colleagues who are preparing for the CAIIB 2026. We are going to cover each and every single point related to it. Now, let's talk about the CCB, that is capital conservation buffer. So when the banks are going through the normal times, the banks are to prepare a buffer. Buffer is just like a saving that we do for the hard times, right? Let's say you are saving some money, you are saving it for the emergency purposes. Same is the case with the CCB, that is a capital conservation buffer, because it was felt like that the banks must be having some extra cushion with them so that they can withhold with the downturns, or let's say when the economic drawdowns are there, so it can be drawn down, right? So that was the case related to the CCB, that is a capital conservation buffer. And when I told you about the classification, I already told you that CCB is to be maintained in the form of the CET1 capital. Now CET1 capital is to be maintained, right? So same components would be applicable to the CCB. So we can say same components as of CET1 capital. Now in case of CET1 capital, we were having 10 components. From those same 10 components, the CCB is to be maintained. So it will be just like a very good liquidity that will be available to the bank, or capital that will be available to the bank. Okay. And the CCB is to be maintained at 2.5%. It is to be maintained at 2.5%, right? So that is the case. Do not look at this table. Previously it was there, like if there is a shortfall in the CET1, then this particular table was applicable. Like in total, if you are having the CET1 ranging from 5.5 to 5.96875, 5.5 to 5.96875, then you are to retain 100% of your earnings next year. That was the case. I'm just going to explain you, just do not worry about it. So just remember that you are to subtract 5.5 from the first term, right? Here you have to subtract, like you're having the 5.96875 minus 5.5. So it will be equal to 0.46875. And further, this is the range which is given over here. Like go for the second term. It is 6.4375 minus 5.96875, right? That is equal to 0.46875. So that is the point that I'm going to explain, that you should be memorizing 5.5 and 0.46875, and using this term just add on to the last one and you will be able to form the complete table, right? So we will be adding this term to the first one and you'll be getting this one, and for the this term will be added to this one and you'll be getting this value, and further this one to this value and you'll be getting this value, and so on, right? And you can be preparing the complete table that is mentioned over here. Now the point is that if we are having the total CET1 as maintained in the tier 1, as maintained under the CCB, if the total CET1 is ranging between 5.5 to 5.96875 for any of the banks, which is to maintain the capital adequacy ratio, right? In that scenario, 100% of their next year earning must be retained. And the second case, if the earning is between the second bracket, then in that scenario, 80% of their next year earning is to be retained, and so on. But that was a previous concept. But because previously it was like that the banks were to maintain the CCB in the trenches of 0.625. There were 4 trenches which were announced by the Reserve Bank of India, and as 0.625% of the step up was there. Like for each of the trench, banks were to maintain 0.625% of the CET1, right? And exceed in that way, and 4 trenches were there. So that was actually equal to 0.625 multiplied by 4, and that was 2.5 in total. That was 2.5 in total, but now it has already been made mandatory, right? It has already been made mandatory that all the banks are to maintain CCB, that is capital conservation buffer, to be at 2.5% out of the CET1 components. Clear? Okay. No. Next, it's related to the counter cyclical capital buffer. It is a counter cyclical capital buffer. Now, what is CCCB? That is counter cyclical capital buffer. Now, it's actually a macroprudential goal. What? It is a macroprudential goal. So, whenever there is excess aggregate credit growth, it's already a risk toward it. It's already a risk toward the bank. That is a triple CB. That is a counter cyclical capital buffer, right? And for counter cyclical capital buffer, we are to maintain again the ratio of CET1 from 0 to 2.5%. But in India, it is not applicable. It is not applicable. And there is actually a trigger related to it. So as to activate the CCB, there is a trigger. So when that trigger would be available, then the banks would be obligated to maintain the triple CB. But otherwise, there is no point related to it that the banks are to maintain the triple CB right now. Is that clear? Are you clear with this? First of all, please confirm. Okay, now let's discuss this thing. First of all, let me just tell you that triple CB is also made out of the CET1 components. Let me write over here, same as 10 CET1 components. And the ratio must be ranging from 0 to 2.5%. These are the important points. And why it is to be maintained? Because if there will be very high credit growth, in that scenario, it's going to impose an excess risk on the bank. And for that particular purpose, a counter cyclical capital buffer is to be maintained of up to 2.5% of the total risk-weighted assets. But the major point that we need to understand, that's about the activation and the deactivation. When it will be deactivated or deactivated. So the decision to activate the triple CB, that will be pre-announced. That will be the pre-announced. And the main key indicator, we can say the main key indicator which will be leading the trigger to be there, that's actually the credit to GDP gap. So main indicator is credit to GDP gap. That's the first case. This is a primary indicator as per the Reserve Bank of India, right? So you should be understanding that in case of triple CB, the primary indicator is what? It is credit to GDP gap. So if the credit to GDP gap in India goes beyond some threshold level as fixed by the Reserve Bank of India, in that scenario, the systemic financial risk can be there, or it could be considered as an early warning indicator. It would be considered as a early warning indicator. right? Like for regulatory threshold, let me just tell you, for the Basel framework, if this particular gap, credit to GDP gap, is up to 0 to 2%, then we can say it is a normal stage. It's a normal stage. And if it is greater than 2%, then we'll be considering it is a early warning signal. And if it is basically around 10% or higher, or we can say greater than or equal to 10%, right? In that scenario, it's a strong signal that the excessive credit growth is there, right? And the maximum of the counter cyclical capital buffer is to be considered in that scenario, right? And the supplementary indicator are related to what? It could be related to the GNPA growth, right? It could be related to the incremental credit deposit ratio, right? Or industry outlook indices over there, right? So those are the supplementary indicators, but the main indicator related to that, when the triple CB is to be implemented, or CCYB, that is counter cyclical capital buffer, is to be maintained, that is credit to GDP gap. And if it is above 2%, then it's an early signal. Then RBI may say that you are to maintain the triple CB now, but right now it's not activated in India. It's not activated in India here, right? Now, let's talk about the leverage ratio. Now, let's talk about the leverage ratio. Again, very much important. Very much important about the leverage ratio. So, one point is related to it, that if you're having the on balance sheet exposure and off balance sheet exposure, it may be the case that you're highly leveraged. Now, leverage is just related to, let's say, case that let's take case. Let me just give an example first of all. Okay, so if you're having rupees 100 with you and you lent rupees 80 out of it, or let's say you lent rupees 60 out of it, right? Then it's all fine. It's all fine. But let's take the case that you are having rupees 100 and you lent rupees 60 out of it. Now people basically did what? That they further deposited rupees amount with you. Now you are having rupees 140 with you. You're having rupees 140 with you, and you lent again. And you lent again. Let's say you lent 50 again over here. And for the 30 was deposited with you, you were having 170 and you lent again. You made a lending amount, let's say 30 over here. Now the total amount which was lent by you is 140. It is 140, but actual amount that you're having with you, actual money that was actually available with you, that was 100 only. Getting my point? So this is somewhat multiplier there. This is somewhat multiplier there. It means the leverage is there, that in total you are having only rupees 100, but you have lent more than rupees 100 there, right? That is what, that is leverage. Same way you can understand, let's say the case that you are having just rupees 10 with you and you have bought things amounting rupees 25. That's leverage. And whenever leverage is there, earning opportunities do increase, but so as the risk. So the risk also increases very much. Okay, so it is very much not decided in case of the economy that we are to maintain the leverage ratio. And the formula for the leverage ratio is very simple. The formula is very simple. It is tier 1 capital, the total tier 1 capital, divided by the total exposure, divided by the total exposure, multiplied by the 100, multiplied by the 100. And the minimum leverage ratio which is to be maintained is 3%. So minimum leverage ratio, this is a minimum leverage ratio that the banks are obligated to maintain. It is 3%. Minimally this much leverage is to be maintained. This much leverage ratio is to be maintained, and it will be applicable on all the scheduled banks, right? So Basel 3 is actually very simple, and it gives us a very simple ratio about it, that is a leverage ratio. Okay, and this ratio is to be calculated on the quarterly basis. On quarterly basis, we are to calculate this ratio. Okay. Further, it's related to LCR. LCR is what? It is a liquidity regulation. Let me write over here. This is the liquidity regulation. Now, what is liquidity regulation? that you are to regulate your liquidity. Whatsoever outflow are going to be there, net outflow are going to be there in the upcoming 1 month or 30 days, those much high quality liquidity assets must be maintained by you. This is the main crux of the LCR, that is liquidity coverage ratio. So it's about the short term resilience of the bank. Like in short term period, do we have the sufficient high quality liquidity assets with us? That is the case, that the bank must be having a sufficient amount of HQLA. We say the high quality liquidity assets to be HQLA. So the banks must be having sufficient amount of high quality liquidity assets, so that in case if there is any stress situation for the short term period, at least the bank should be having the high quality liquidity assets where the bank can pay off the net cash outflows for the period of 30 days. For the period of 30 days, we must be having such those much HQLAs with us. So what is high quality liquidity asset? Like if you are having gold with you, definitely you can go to the market and sell the gold and you'll be getting the cash without any haircut. That is a high quality liquidity asset. Now, if you're having the government bonds or government securities with you, if you have invested in those securities, you can be selling in the market, but those should be unencumbered. No charge must be credited upon them. Then only the point goes right. Okay. So we must be having clear in our mind that liquidity coverage ratio is telling us about the short-term resilience, that do we have the sufficient assets with us? Do we have the sufficient high quality liquidity assets with us so that we can survive under the stress condition for the next 30 days, that we can pay off our obligations at least, right? And the LCR is to be maintained at 100%. At 100% level it is to be maintained. So minimum 100% level is to be maintained for the high quality liquidity assets, right? That is LCR, that is liquidity coverage ratio. And the formula is stock of HQLAs divided by total net cash outflows over the 30 calendar days. Over the next 30 calendar days, this is the formula related to the LCR, that is liquidity coverage ratio. And it is obligated upon the bank so as to maintain the 100% of the LCR. Do not pay attention toward this table, not required, because it was related to the COVID period. At that particular time it was required, but for now it doesn't make much sense. Okay. And further, it is the next ratio is NSFR. The next ratio, it is NSFR, that is net stable funding ratio. Now where the LCR, we were concerned about the short-term resilience. In case of the NSFR, that is net stable funding ratio, we are concerned about the long-term resilience over the long-term time horizon, right? That is the case, that we are looking for the long-term duration, that over the 6 months period, would we be able to survive or not? Would we be able to survive or not? We are talking about that thing. Okay, so the NSFR is related to it. After that, let's learn about the HQLA, and we will be covering a very good case study in the next video. In the next video, we'll be covering a very good case study about the HQLAs, that is high quality liquidity assets. But let me tell you the description related to it so that you can solve the questions related to it in the next video. Now, HQLA are related to what? These are high quality liquidity assets, and these are divided into two categories. So if we are talking about the HQLA, we are having the two category, that is level 1 HQLA and level 2 HQLA. And level 2 HQLA is further divided into two categories, level 2A and level 2B. Okay. Now level 1 assets are those assets which can be converted into cash, or we can say which can be converted without any haircut. No loss of the value will be there. That is level 1 asset. That is going to be level 1 assets that we are going to convert without any loss to the value. And level 2 assets comprise of level 2A and level 2B, right? And these are subject to the maximum haircut of 50%. Maximum haircut of 40% in case of level 2 assets, level 2A plus level 2B. So overall haircut, if we talk about in total about the level 2 assets, the maximum haircut should be limited to maximum of 40%, right? And in case of level 2A, minimum 15% haircut will be there. Minimum 15% haircut would be applicable, and in case of level 2B, minimum of 50% haircut would be applicable. And there is one more restriction toward it, that the maximum value of the level 2B assets cannot be more than 15% of the total stock of HQLA. Let's say if you are having the total stock of HQLA to be rupees 100 crore, in that scenario, the total of the level 2B assets cannot be more than 15 crore in that pile, right? Is that clear? Okay, so whatsoever the securities which are actually eligible for the statutory liquidity ratio, those are eligible for the SLR. So if the bank has invested under the SLR and has basically procured the securities, and those securities are also eligible for the HQLA purposes, if those are not encumbered, that's the one thing, those should not be encumbered, right? And further, there is a term that is FALLCR. Now, what is FALLCR? That is facility to avail the liquidity for the liquidity coverage ratio. Now, see, look at one particular point. The banks are to maintain the CRR. The banks are to maintain the statutory liquidity ratio, SLR. The banks are to maintain the capital adequacy ratio. The banks are to maintain the provisions on the standard assets as well as on the bad debts, right? So how the banks can be profitable even after taking so much measures, right? How they can be competitive? So for that particular purpose, there is a facility which is available to the banks, and that is FALLCR. Now, FALLCR is related to facility to avail the liquidity for the liquidity coverage ratio. Liquidity coverage ratio, that the banks are to maintain some points. Now, FALLCR is basically is a stress indicator measuring the adequacy of the banking capital, right? Capital about it. And if we talk about the facility to avail the FALCR, it is said to be around 15% of the bank's NDTL. So whatsoever the bank's net demand time liabilities are there, whatsoever the bank's net demand time liabilities are there, under that particular thing, it's a facility which is available to the banks, which permits the banks so as to avail the funds from the central bank so as to meet the liquidity coverage ratio requirements under the stress. And in that scenario, it basically prevents forced sale of the HQLA. Forced sale will not be there in that scenario, because you are eligible that you can sell 15% of the bank's NDTL amounting FALCRs, and that to the central bank also. So you won't be, that in stress scenario, there will be not any kind of forced selling. There will be not any kind of the forced selling. So all the scheduled commercial banks, right? And further, those are eligible for the same facility. Those are eligible under the same facility. Okay. So here is the point which is mentioned, that at present the assets which are allowed as a level 1 HQLAs inter alia includes, among others, within the mandatory SLR requirements, government securities to extent allowed by Reserve Bank of India. Okay. So here's the case, and next we will be going for the case study that we are going to cover in the next video, not today. So in the next video, we are going to cover the case study about the HQLA. We will be covering the case study related to the basic indicator approach. So make sure to watch that particular video, and tomorrow there will be no session for the CAIIB in the evening, although sessions related to JIB and bank promotions will be there in the morning. And the same CAIIB session will be there on Sunday at 9:30 a.m. right? So at 9:30 a.m. on Sunday, 9:30 a.m. day Sunday, there will be session related to the CAIIB BFM. So make sure to watch that particular video, and we'll be setting up a reminder for you. So if you have liked the content so far, if you like the video, if you have learned the concept, make sure to like this video and share this video among your friends and colleagues who are preparing for the CAIIB exam. And if you want to get the PDF of this file, and if you want to watch these videos further, the videos will be available shortly just on the our application. So you are to download the application, which is available on this link, iibf.info/app. Make sure to download the application and do share your love with us. Thank you so much, and see you again in the next video. Happy learning.